What if every time you made a payment on a debt, the payment went to you? What if you controlled the interest on all the debts you have? What if you could just decide who was in control of your money? What if you could do the same thing that all the big bankers do, the Rothschilds, the Rockefellers, the Morgans, the Stanleys, and so many others? What if you truly had the ability to be your own bank? Wouldn't that be awesome? I'm Chris Naugle, and this is What Now, What's Next? Let's talk banking. You know, when I think about banking, I think about some of the wealthiest families in history. I think about the Rothschilds. I think about the Rockefellers. I've read books on the Stanleys. I've read books on the Morgans and so many other huge banking families. But if you really go back in history and you start looking at what those families did to create wealth, it's brilliant. They decided that they were going to take back control a long time ago, and here's how they did it. Even though they're bankers and they controlled many of the powerful banks there are here and in London, you also have to understand that they learned how to create banking systems. These great families created a banking system but not using banks. They took the banking systems and the banking strategies and they applied it somewhere else. See, they figured, what is the strongest financial institution that there is in the world? And they arrived at one place: giant, mutually owned insurance companies. What? You see, how they arrived at insurance companies is insurance companies are the most conservative financial institutions in the world, but also insurance companies have all the money. Banks have your money and all the other depositors' money. Insurance companies, they have their own money. And they have lots and lots of it. And these great families saw that and they said, well, we should be using insurance companies as a warehouse for our wealth. But they couldn't just walk into these giant mutually owned insurance companies and say,
hey, I'm here and I got all my money. Can I deposit it into this insurance company?
The insurance companies aren't in the business of taking your deposits, or are they? These families had to figure out how to get their wealth into these insurance companies if these insurance companies didn't function like the banks they were used to. And they figured it out through a product that has been around for a very, very long time, and actually a product that has been completely beat down. And in today's world, most people think it's the worst place you can put money. And that is a whole life insurance policy. You see, with these mutually owned insurance companies, these great families would deposit money into these whole life policies, but they would create whole life policies that were different than the ones the average person was buying on the street. Because most people buy whole life and they think of whole life as life insurance that lasts their entire life. And many others think of whole life as,
oh, this expensive, overpriced life insurance policy.
And we'll get to that. But you see, when these families got together with these insurance companies, with their great wealth, they found ways to construct and engineer whole life insurance contracts so that it was favorable from a banking standpoint. Now that these families had a way to store and warehouse their wealth in insurance companies through whole life insurance policies, they now were able to control everything. Because the insurance companies were able to do something that the banks were not. The insurance companies could provide guarantees and promises. And they could do that for hundreds of years into the future. Because the insurance companies didn't play the short game, they understood that wealth was the long game. Wealth is a marathon, and it should be for you too, but too many people are sprinting to riches. Banks are always sprinting to make returns and profits for their shareholders. Insurance companies, especially mutually owned ones, care about policyholders because their stockholders are policyholders in a mutually owned design. Not only that, giant mutually owned insurance companies pay dividends as well. So they make a couple promises. They promise to pay a guaranteed interest rate, usually far more than what any bank or any financial institution can make. So that's first thing. Second thing, the rules and the way that the tax code is written or not written, for that matter, when it comes to life insurance, allows life insurance to have tax advantages. Not only that, life insurance provides a legacy. And these wealthy families understand legacy better than just about anybody, because when one of them passes, the money from the life insurance proceeds then flows to the trust, which seeds the next generation. the next generation of that family's legacy. And that continues on and on and on. And that's exactly what the Rockefellers and the Rothschilds and so many of these other great banking families do. They've created banking systems that they use immediately, and they've created legacies that carry that family into the future so that each generation, they are wealthier and wealthier because of compound interest and life insurance proceeds. So let's dive in, because now you're probably thinking, well,
why would I ever put my money in whole life? Because I'm not a wealthy family. I don't have enough money to build and construct these specially designed whole life.
but you're wrong. You do. Hasn't always been this way, but now you do have the ability to create your own banking system the same way the Rothschilds, the Rockefellers, the Morgans, the Stanleys, the Walt Disneys, the Ray Krocs, right on up to the sitting president, Joe Biden.
I stand squarely behind my decision.
So what are we talking about? Yes, we're talking about a whole life insurance policy from a mutually owned company that pays dividends. That is a fact. But the other thing you have to understand is these life insurance contracts are designed and engineered to be completely different than the ones that you buy from your agent, from your financial advisor, or from your broke-ass brother-in-law. They are designed to work for banking. Commonly in today's world, it's called the infinite banking concept, founded by the late R. Nelson Nash, who wrote a book called Becoming Your Own Banker, which is where this process begins. So the policy does pay you a guaranteed interest rate. Plus, all the insurance companies that will do these types of policies have paid dividends for hundreds of years, at least over 100 years, consecutively without ever missing one, not even through the Great Depression. So you can see the strength of these giant insurance companies. But then comes the factor of why you use a regular bank. See, you've been taught through your life to trade your hours for these, for dollars. All of us, we have a specific amount per hour that we are willing to work for, and we get these, and then what do? Well, we gladly march on down to the bank and we say, "Here, Mr. Banker, here's my deposit," and we feel good about it. The bank then in return gives you one of those beautiful suckers in the little cups above where you're making your deposit, and just so you know, those suckers are called dum-dums. Yeah, they're trying to send you a message. And the bank takes your hard-earned dollars and makes that money go to work for them. That's what we do. And all I'm suggesting is doing what the wealthy families do, which is change where your money goes first. Instead of putting it in somebody else's bank, you put it in your own bank. But the reason you put the money into the traditional bank, back to what we were talking about a second ago, is you wanted access. Is your money really accessible when you put it in a traditional bank? Well, if we just go back to when the pandemic started in 2019 and 2020, let's talk about liquidity then. People were lined up at their local banks to take their money out, and could they get it? Nope. The banks had limits. And under rare circumstances like the pandemic, like the Great Recession, and like what's about to happen, you might not have that liquidity you want. But back to the specially designed and engineered whole life, your private banking system that we're talking about setting up, just like all those wealthy families. The money goes in there. How liquid is it? Immediate. If you need your money that you put into that policy, as long as it's specially designed and engineered by someone that knows how to build policies like that, such as us, you have access immediately in the first 30 days you deposit the money. Or as soon as your money clears, you have access to a percentage of that money. So how much? Well, normally, depending on the plan design, it's going to be between 60 and 90%. So I put the money in there, and I now need that money. I log into my account, or I call the insurance company and say, "Hey, I need to take my money." And then I take a loan from the insurance company, because why a loan? Why wouldn't I just take a withdrawal? I don't like loans. Well, because you want to take loans. Because if I have $10,000 in my private bank at the insurance company, and I take $10,000 out as a loan, what that is the insurance company is giving me $10,000 of my death benefit early. Because the insurance company made a couple promises. They're going to pay a guaranteed interest rate and a death benefit when I die. So now they're giving me $10,000 of my death benefit that's going to be paid when I die, but they're giving it to me early as a loan. Does this loan need to be paid back? Well, yes. But does it really need to be paid back until the day you die? No. The insurance company will never ask you for that loan back, because they know someday you're going to die. I always call it graduate. And when you graduate, they're going to subtract that $10,000 loan that they gave you against your death benefit from the death benefit that they pay out. They're made whole. And they charge you interest on that loan, but the interest they charge on the loan is less than the amount that they're paying you. So how does a bank, a traditional bank, make money? They make a spread. You deposit money in the bank, hypothetically they pay you 1% interest on that money. The bank then makes that money go to work for them and charges 5, 7, 10% on the loans that they make, and they make a spread. So if the bank lends the money out to your neighbor for his new car at 5%, but they're paying you 1%, how much did the bank make on your deposit you put there? 4%, a 4% spread. Your private bank works identical. The insurance company pays you a guaranteed interest rate plus dividends. And they charge, when you take a loan from your bank, they charge interest because they're giving you part of your death benefit early. But none of your money has left the account. If I put $10,000 in and I take $10,000 out, how much is left in your private bank at the insurance company? If done properly, $10,000. Because remember, the $10,000 that you took out as a loan was your death benefit you took out. And the death benefit that you took out as a loan was collateralized by the money in your account. You see, this is where the power comes in. Because you have all your money working for you, uninterrupted. Your money stays in your account, earning interest and dividends, compounding uninterrupted, year over year over year, while you have the ability to take loans out and use that money, invest that money, lend that money, do whatever you want, and all the while, you're making a spread. Compound interest. Compound interest is the eighth wonder of the world. Those that understand it earn it. Those that don't pay it. You pay it, the banks earn it. Welcome to banking. But you can change that. You can change that by changing where your money goes first. You can change that by applying the infinite banking concept, which is a process of moving your money. Can I give you a quick example? This is a simple way, not so much a way that the Rockefellers or the Rothschilds would use that money, but let me just give you an example. Let's talk cars. All of you have a car, right? You can buy a car by paying cash for it. You can buy a car by financing it. You can buy a car by leasing it. And heck, you could even steal a car. But most of you finance cars. And when you finance a car, the bank loans you money, which comes from deposits that were made in their bank. They lend that money to you at an interest rate. And you, in turn, decide you're going to make monthly payments of whatever dollar amount. Let's just say it's $500. You're going to make monthly payments back to that bank every single month as a repayment of that loan. Great, you understand that, right? We all do that. Every month, $500 leaves your family forever, and the bank now has $500 more. And they made a spread on this. So now let's change the dynamic. You want to buy a car. But this time, you save up money in your private bank. You've got 20 grand in your private bank. You take a loan from your private bank for $20,000, which means your 20 grand stays in your account. The insurance company gives you $20,000 of your death benefit, in which you go and you buy that brand new car for 20 grand. Now that car would have cost you $500 a month, because we just talked about that. If you borrowed the money from the bank or the car finance company, every month you were giving them $500. But now you're the bank. You took 20 grand from your bank. So you would take the $500 that you would have used to give to somebody else's bank, and you're going to take that money, you're going to put it back in your bank. And every month you're going to do that. Every month, just like you would of the regular bank, you're going to take $500 and you're just going to keep paying that money back to your bank every month. So you know what's going to happen? Every month, you have $500 more. And you know what's going to happen over 5 years or 6 years, however long you finance that car? That's right. You're going to get all the money back for that car because you were the bank. But what else did you do? You made money on that car. You made money on that car because the whole while you earned a spread. Not only that, your money continued to earn uninterrupted compound interest. Folks, if that works for cars, it works for boats, it works for planes, and it even works for credit cards. If you were to take money from your bank and pay off credit cards, take the money you were given the credit cards and pay it back to your bank, you get all the money. You keep the interest rate, you control the flow of money, you do what every single bank does every day. If everybody else out there that's in the financial world is saying whole life is trash, Why would you ever buy a whole life? Well, maybe you won't. But let's peel the onion once. Why is it that the insurance companies and the financial companies all want you to buy term and invest the difference? Well, let me give you the truth. Listen up and pay very close attention here. If you had a product that your business sold, and that product was the most profitable product your company has ever created, if that product was a product that you only had to fulfill on or pay out on less than 2% of the time, which would mean that 98% of the time you're profiting from this product, is that a product that you would market?
Oh, yeah.
Is that a product that you would train your sales team on?
Oh, you bet your butt. Yep, sure would.
Is that a product that you would focus your entire company's efforts to sell?
Oh, yeah, absolutely. 98% profit every time. Yeah, oh, yeah, I'd go all in on that.
Well, you know what that product is? Term insurance. Insurance companies pay out less than 2% of all the term policies written. So therefore, it is single-handedly their most profitable product. They certainly spend the most amount of time training their sales force, which are the financial advisors, the agents, the Dave Ramseys, the Susie Ormans out there. Of course, that's what they want them saying, because why would you want Dave Ramsey selling whole life where the insurance company has to pay out on that policy 100% of the time, instead of having Dave Ramsey talk about term insurance where Dave Ramsey's pitching a product that the insurance company only has to pay out on less than 2% of the time? Is this making sense? Do you understand why everything you've ever been told says buy term and invest the difference? I didn't even cover the second part. So now that they've brainwashed you to buy the most profitable product on earth, which is term insurance, maybe not on earth because the dollar is the most profitable product, but the most profitable product the insurance company has, which is term insurance, then why would they let you keep the remaining amount that you normally would have put into a whole life? Well, they wouldn't. Let's invest the difference. And what are they going to suggest you invest into? Well, probably financial products, mutual funds, ETFs that company offers or gets paid on. Doesn't that make sense? Let's sell the most profitable product and then take the difference and have them invest that difference back with our company so our advisors get paid, so we get paid, and so we control all the money. Wake up! You were brainwashed. You've been lied to your entire life. I'm sorry to be the one that has to bring this truth to you, but wake up. The wealthiest families don't do what you do. The wealthiest families are not buying term, investing the difference. They're buying whole life, specially designed and engineered whole life. You know who else is buying whole life? Banks. Banks are the #1 purchasers of whole life in the world. Oh, you don't believe me? Great. Prove it to yourself. Google BOLI, B-O-L-I. Sorry, I'm getting a little upset, but honestly, this stuff is logical. BOLI, B-O-L-I. Google it. You will find hundreds of pages coming up talking about bank-owned life insurance, BOLI. You'll find that banks own more whole life than anyone else. To the tune of 2019, banks owned $191 billion worth of whole life insurance. The top 5 banks in this country alone own over $75 billion of whole life. Now, is that because banks are stupid? No, we already determined that they're very smart. They understand compound interest. They charge you compound interest. You gladly pay them. They've convinced you to give up control of your money and just put it into the bank so then they can make your money go to work for them so that you can't make your money work for you. Banks are brilliant, but banks also know something you don't up until now. I just gave you the formula. The formula that the wealthiest families in history have used. The formula that banks themselves use. The question is, are you going to use it? If you want more information about this, check this video out. This video shows you the entire infinite banking concept. It shows you how to get all the money back for all the cars you're going to buy, drive, and own, as well as how to erase debt using this concept. If you enjoyed this, subscribe to this channel and click the alerts button too so you're notified every time we do a video. I hope you took something from today's episode of What Now? What's Next? And what's next is you're going to be the bank.